Hi, I'm Bruce, the Apartment Guy Peterson, and this is Multifamily Valuation. So goals and objectives for the class. To understand what goes into valuing a multifamily asset, learn what a cap rate is and the power it holds in value creation, how relatively small improvements to profitability can have a dramatic effect on your value, and how the income approach versus comps approach makes multifamily such a better wealth creation vehicle than single family. Did you know relatively small improvements in a property's profitability has a large effect on its value because of the power of leverage and the cap rate? For every additional dollar in profit, the value of the property increases, we'll say a range from about $12.50 to $20. So it's the power of leverage that if I make a property $1 more profitable, it makes the property $20 more valuable. Very powerful stuff. So a few key definitions we have to have in hand before we keep going on this to understand it all. So you're going to have to know your operating income, and that is a total income generated through the day-to-day operation of the property. Operating expenses, basically the same thing, all expenses incurred in the day-to-day operation of the property. And then you have your NOI, which is operating income minus operating expenses, gives you your net operating income. That's basically your profit before your debt service is figured in or your loan, and any capital expenditures and non-operating expenses are figured in. And then you have a cap rate, the expected one-year return on a piece of commercial real estate when purchased with all cash, or basically no debt. Examples of operating income. You got rent, application fees, admin fees, late fees, washer and dryer rental, reserved parking, RUBS, vending income, and anything else you can think of to charge that people are willing to pay for. Those are operating income items. Then examples of operating expenses would be payroll, repairs and maintenance, marketing, utilities, taxes, insurance, professional fees, which would be evictions, property tax protest, cost segregation studies that you'll get done. Those are some examples of professional fees. Then you have admin expense and management fees. All right, so the formula is value equals NOI divided by cap rate. That gives you the value of the property. So let's put it all together. So we're going to have an example property, a 20-unit property that we're going to buy. Purchase price is going to be $1 million. This may be accurate for your market, may not, doesn't matter. This is just an exercise. The down payment, we're going to assume that you get an 80% loan or a 20% down payment. So you're going to have a $200,000 down payment. Your loan amount will be $800,000. Your closing costs will be estimated at 5% or $40,000. And your out-of-pocket total is $240,000. That's basically the amount of money that you have to write in a check at the closing table. It's the exact same information, just presented in a different form. We're going to say for this property that your operating income is $160,000. Your operating expenses are $80,000, which is kind of typical. Most of the time on a property, you are going to run about a 50% expense ratio to your income. Rule of thumb, but it's usually pretty close to that. The resulting NOI, or profitability before debt service, capital expenditures, and non-operating expenses and income, remember, $80,000. That's your profit. So you take your profit and divide it by your cap rate. And remember, your cap rate is the expected return on a piece of real estate without debt service. So in this example, we're going to break it down into two different columns. One is an 8% cap rate and one's a 6% cap rate. So remember, if you take your NOI and divide it by your cap rate, or 8%, the value of the property is $1 million. If you change that cap rate to something that's a little more realistic in today's market, most of the deals that I'm seeing right now, selling or buying, they're trading at about a 5 to a 6 cap. So we're going to say, in this example, we're going to look at a 6 cap. You get $1,333,333. That little change, now it's not a little change, that's a huge change in cap rate. But just to go from an 8 cap to a 6 cap, that made you 33% more in value. more of the putting it all together. So let's say this exact same property, you make more profitable by 15%. Basically, you're just going to increase the income by 15%, keep your expenses stable. You are driving income up to $184,000. So you take your operating income, subtract your operating expenses, your new NOI. Your NOI has gone from $80,000 to $104,000. So if you use your two different cap rates in these examples, take your $104,000 in NOI divided by an 8 cap, that's a new value of $1.3 million. If, again, more appropriately in today's market, you use a 6 cap, you end up with $1.73 million. Massive difference, because remember, you only paid $1 million for this property. Taking it one step further. So the way this works, this is why we do commercial real estate. I buy a property that's worth $1 million. I own it for 6 months, a year, 2 years, and I do make it more profitable, as in this example. When you go back to the bank, you should be able to, as long as the market's cooperating, you go back to the bank and say, look, I want the same 80% loan that you gave me before, but I want it based on the new value. And that's what we do. That's why we're in commercial real estate. That's one of the big reasons. So going through that, so now on an 8 cap, your new value we decided was $1.3 million by doing our formula. You take out a new 80% loan for that new value. Now your loan is $1,040,000. You pay off your first loan because you still have to pay that off. It's still owed. That's $800,000. You are left with $240,000 in loan proceeds. Your original out-of-pocket, if you remember, so your original full investment for this $1 million property was $240,000. You just got $240,000 in your new loan. After you paid off the first loan, you still had $240,000 left. Put that back in your pocket if you choose. You can go buy another property, whatever you want to do with it. So you're basically in this deal for nothing. Now, let's go look at it on a 6 cap basis. Your new value, we decided, was $1.73 million. Your 80% loan there is $1.386 million. You still pay off the same original loan of $800,000. So the new loan minus the original loan is $586,666. Remember, you put $240,000 into this, and the bank just gave you a net $586,000. So you made $346,000. One additional piece of goodness, this return of your original investment is from loan proceeds and are totally non-taxed. So what in the hell just happened? By slightly increasing the operating income in the example property, we increased the value of this $1 million property by $300,000 to $700,000. This little 15% improvement enabled you to take your original investment back out of the deal while still owning the deal, or even put some money in your pocket, and you're still cash flowing. Now, with nothing in the deal, you have an infinitive return and can use the cash back in your pocket to buy the next one or head to Vegas. So key takeaways. Commercial real estate done well is a fantastic way to build generational wealth for you and your family due to the power and leverage of the cap rate. How using an income approach to valuation makes commercial real estate a better asset class for wealth creation than single family can ever be. If I buy a house in a neighborhood and I buy it for 80, the neighborhood's worth 100 because the property on your left is 100, the property on your right is 100, the property across the street is $100,000. Doesn't matter what you do to your property, doesn't matter how profitable you get it, your house will be worth $100,000. Here, there's no limit because the only limit is how profitable I can make it. Because when you're buying and selling commercial real estate, which is what an apartment complex is, people are buying a stream of income. The higher that stream of income or profitability, NOI, the higher that is, the more they're willing to pay you to get the same return. So that's just the way the math works. How the magic of cap rates and increasing profitability can create the holy grail of zero money in a deal and help scale your income and wealth exponentially. You know, if you expect to buy the property initially for no money down, not gonna work, right? Maybe 1 out of 1,000 work that way, but don't count on that ever. So don't listen to the people late night TV screaming at you about no money down, no credit, no, doesn't work. But this is how we accomplish no money in the deal. All right, that's it, guys. Thanks so much for watching, for listening, and I hope you got something from this. This is the power of commercial real estate. If you want to invest with us, reach out. If you'd like to learn more about how to syndicate your deals, Remember, you've got the book. You can reach out to us. We have seminars, so let us know how we can help you.